This is Bazaar Morning Call, broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we are coming to you live as always from the CNBC TV 18 Motilal Oswal studios. I am Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, morning.
Hi, good morning, Prashant. Good morning, Nigel. A long week ahead because there's so much central bank action across the globe. But today looks like it's going to be a good start. I mean, the SGX Nifty is a bright shade of green. And the global cues are not too bad either.
They're not bad, but will we have a repeat of yesterday, right? Yesterday also we had that 70-point uptick on the SGX. By open, it sort of shrank quite a bit. But we have solid positive cues this morning. And I'm going to start with something which came out in terms of data yesterday evening, which is the consumer price inflation numbers. We've seen a sharp disinflation in the India CPI, May CPI. Two RBI meetings, prior, that is before the April RBI policy, inflation was 6.5%. We're at 4.25%, April to May. That is the kind of disinflation we've seen. And I think this number, while this is in line with expectations, this kind of bodes well for the RBI to turn decisively dovish in August. Not rate cuts, but many were expecting a change in stance in the RBI meeting which just happened. Maybe we'll see that in August. Of course, all of this depends on how monsoon rains pan out and what that does to food prices, etc. But this is, I think, in terms of just handoff from data yesterday, unambiguously positive. Overnight, the cues are decent. The Nasdaq ended up about 1.5% higher. The S&P was up about 0.9%. There is a sharp 4% fall in oil prices as well. And I think this is important to highlight. And it's quite stunning, right? Saudi Arabia, for example, at that last OPEC meeting, cut output unexpectedly, but prices have not budged. If anything, they've actually gone down, gone south, and tells you what the market is kind of focused on, which is anticipating that perhaps growth is not going to be strong. Now, in terms of further cues, and I think the next 2 days are going to be important, will affect how much risk-taking people want to indulge in. The US CPI number is later today, and then you've got the FOMC meeting tomorrow. The Fed decision we will react to on Thursday morning, and that's why I'm saying that, this is going to be a little tricky. I think in the US, markets are there's no volatility. There's no fear. And there is no fear that there will be volatility around this CPI number. More and more people are getting convinced that maybe we will see a pause and perhaps the peak of rate hikes are behind us in the US. So that's the positioning. So if you're trading very near term, you need to be cognizant of this, that markets are not prepared for any large volatility based on what the Fed chair, etc. may say. So I think one needs to keep that in mind. Now, yesterday, the Nifty bounced off an important level, which is Friday's low. Friday's low and yesterday's low are almost exactly same. Mid-caps and small-caps did well. The Nifty was up 0.25%, but the small-cap index was up 0.9%. The mid-cap index about 0.5% or so. So there's no problem there. It kind of just picked off from where we left off last Wednesday. Thursday and Friday, of course, we had seen some pullbacks. So Friday's low becomes important. 18,555 is that number. On the way down, that is. We are just 50 points away from that. And then there is the 20-day moving average, which is 18,453. Another 50 points. Another 100 points below Friday's low. So these are support levels to watch out for. On the way up, Thursday's high becomes important, which is the level to take out for further upsides to materialize. That number is 18,788. Bank Nifty yesterday closed marginally below the 20-day moving average. It's been around that level for the last several days. And yesterday we got a close which is 40-50 points under. But it's not a materially large close which decisively changes the trend. So I would want to watch this perhaps one day more and see what the market wants to tell us. So the Bank Nifty 20-day is at 43,980. But I think the 40-day exponential moving average, if the 20-day breaks, and we get one more close below the 20-day, the 40-day exponential moving average at 43,352 comes into focus, which, by the way, again, is not very far away. It's about 500, 600 points away. Resistance level for the Nifty Bank comes in at 44,499. It's a level which the Bank Nifty has hesitated to cross, has not crossed for several days to come. SGX is indicating a positive start. You got the handoff from US, you got the CPI numbers, all positive. But I would still say if you're trading, given the event risks over the next couple of days and the loss of momentum, there is a clear loss of momentum in the Nifty, in the large cap space. I mean, you hold off, watch like you did yesterday for the first 1 hour or so, and then decide if you want to buy that dip. I mean, you do get a dip and then you get a bounce. Maybe you play that, but don't chase the open right at the outside, right at the open. Sonia.
Oh, absolutely. I mean, the SGX Nifty for now is indicating a positive start, but there are big global events upon us. The US FOMC, there is the Bank of Japan meeting, the ECB meeting as well. You don't know which way things could go. But you know, the global markets were very strong, the US market specifically. And one thing I noticed is that the dominance of big tech is back. So whether you look at Apple hit all-time high yesterday in terms of stock price. You also had the market cap of Apple has now exceeded $3 trillion, the valuation of Apple. So that's, you know, one big move over there. Tesla is up for the 12th straight session. Oracle was up about 4%. So in that context, big tech is back, and perhaps it could extend into our markets. You never know. We've seen a comeback, especially in some of the mid-cap IT stocks. So that's one pocket to look at. Apart from that, you have, of course, expectations of a pause by the Fed. So everyone's looking forward to that. Nikkei has hit fresh 2023 highs as well. So across the globe, you know, this morning Hang Seng is under a bit of pressure, but the Japanese market has been doing very well. In our own markets, there's been very strong buying from domestic institutions, second straight day of four-digit buying there. In fact, in just two trading sessions, we've seen in excess of 3,000 crores come into the Indian markets from the domestic fraternity, although FIs continue to sell. And of course, the macros continue to improve. So retail inflation has dipped to a 25-month low. But is all of this enough for the Nifty to move out of the resistance zone? No, I'm not too sure about that, because this 18,600, 18,650 level has been a bit of a sticky zone for the market. This morning, the SGX Nifty is indicating that we'll sort of make an attempt to get there and get past it. But let's see how the second half of the trading session goes. But sectorally, my eye is now in the IT space after what we're seeing transpire in the global markets, especially in the US.
Well, you know, Sonia, the headline index may wait to see what the Fed will do. But the mid-cap and small-cap indices, they are saying you could wait for the headline index. We are going ahead.
Yeah.
You know, that's been the theme for the last few days. Even yesterday's trading session, the mid and the small-cap indices, well, they did very, very well in trade yesterday. Now, lower crude prices, this morning crude price is down 3% overnight. And in the last 1 week, it's down by close to around 10%. That's a positive. The lower inflation print is what we have gotten as well. The big question is, can the Nifty bank find its form? That's going to be important, because the last couple of sessions, you know, from the RBI governor's speech itself, it's corrected close to around 800 points approximately. So is it done with this, its lull? The 43,700, well, that's the lowest level we've seen in the last 11 sessions. So can we see a bounce on the Nifty bank? And importantly, today is the Nifty Financial Services Index expiry, since it's a Tuesday, so we'll see some bit of volatility pick up out there. A quick word on the institutional data. The institutions were net biased because the DIs, they are pumping in the big money. But the FI participation actually is quite much lower. If you look at the FI participation yesterday and compare it with what we have seen in June prior to yesterday, well, the volumes, the gross volumes are 25% lower. It seems they are in wait and watch mode. So you'll get a better trend coming from the FIs, I think, post the FOMC meet. Yesterday they sold mildly, but the participation itself was much lower. What do the FIs do in the FNO market? Well, they covered some short positioning. Now the shorts are at around 51%. They bought more calls than puts, so that's a little bit of a bullish sign. But what's more bullish is that they wrote more puts than calls. You like to see that. Two strikes were active yesterday, 18,600 put. Well, that had a fair bit of open interest build up. There was writing being seen out there, premium at around 50 rupees. And the calls that were written earlier, there was some unwinding that we saw there, 18,700. With the kind of move that you've seen, with the kind of cues you've seen, I think the call writers got a little bit jittery in yesterday's trading session, which brings us to the levels. If the 20 DMA holds out, well, everything is okay. You'll have to maintain a long position out there, though resistance comes in closer to around that 18,800 odd mark. And since it's a Nifty Financial Services Index expiry, there was writing being seen at around that 19,450, 19,500 puts. There was actually a fair bit of action that we saw there. Resistance comes in at around that 19,480, because the 19,450 call was very active. So that resistance level is very, very important. And support as well comes in at around 19,350. The final hour or so belongs to the Nifty Financial Services Index. Let's see whether or not it's enough for the Nifty bank to perform today. If the Nifty bank performs, then it'll be good news. Don't chase the opening. That's the call that we made yesterday as well. Don't chase the opening. If you get an intraday dip, maybe you could look to buy into 20 DMA becomes the crucial support level.
All right. Well, so SGX indicating, like yesterday, a higher start, but no point getting right in. You wait the texture of the screen and then decide what you want to do. Well, before we go any further, let's quickly tell you what's lined up here in the first half hour of the show. We get you updates from markets across the globe. Matt Orton of Raymond James Investment LLC will join us to discuss that. Later, our research team gets you the top 10 stocks of the day, and we'll have Harendra Kumar of Elara Securities join in to talk about what he's seeing in the market, his top ideas, top bets. Stay tuned.
All right, we also have a couple of equity views coming in this morning, so let's get straight to it. First up, we have Surendra Goyal of Citi, who says that mid-caps have had a strong 2023 and the outperformance is coinciding with strong momentum in FI inflows in this quarter so far. If history is any guide, a sustained bull rally in equities could lead to more outperformance in the near term. He adds earnings growth in mid-caps is somewhat lagging large caps and could be the key to sustenance as valuation premiums now, both PE and price to book, are above long-term averages. Overall, on the Indian equities, Citi's Nifty March 2024 target indicates just a 4% upside from here. Okay. So I guess range bound is the way to go.
Absolutely. Well, Pankaj Chachor of Antique Stock Broking also comes in. He says that markets may consolidate in the near term given premium valuations, recent macro data from the US, which has led to a sharp upward revision in terms of Fed rate outlook for CY23, that is calendar this year, and expectations of another rate hike in June or the July policy. The third reason he thinks why markets may consolidate is a likely recession in the US in the second half of this year. Overall, given expectations of a capex cycle recovery, they remain constructive from a one-year perspective and prefer industrials, real estate and banks. Antiques March 2024 Nifty target stands at 20,500.
Okay, let's also try and get you some money market views this morning. A lot has happened there. Abhishek Goenka of IFA Global says this is a week of key central bank rate decisions. He says the US Fed was expected to pause, but recent Reserve Bank of Australia and Bank of Canada's surprise hikes have enlivened the Fed meeting. He says if the Fed too delivers a surprise 25 basis points hike, we could see the dollar strengthen. He does not, however, see exaggerated moves and expects the RBI to continue to keep the dollar INR under a tight leash. He also expects the dollar INR pair to trade in a range of 81.60 to 82.90 over the next few weeks.
On bonds, we have Ajay Magnolia weighing in. He's, of course, with JM Financial. He says that fears of further rate hikes among bond traders has subsided a lot post RBI's pause last week and the cooling CPI inflation for the month of May. However, he adds the FOMC decision this week has been creating volatility. He says the sense prevailing amongst most investors is that the RBI might stay its course of maintaining stability in rates and liquidity with a long pause as far as inflation print stays within its comfort zone. He expects the 10-year benchmark bond yield to stay in a range of between 7 to 7.05% for the day.
Well, we have a lot of stock-specific action. We'll get to that in just a bit. But for the time being, let's run you through our top 10 list that we're tracking. We're looking at JSW Steel, Canfin Homes, EIL, SJVN, Inox Wind, and Inox Wind Energy. They are stocks that will be reacting to positive news flow. While on the flip side, we have Hero MotoCorp, Z Entertainment, ONGC, and Oil India that will be reacting to negative news flow.
Okay, well, so that's views and what's lined up here in terms of stocks in just a bit. But Matt